In today's video, we're delving into a pivotal economic event that had a lasting impact on Latin America, the Latin American debt crisis of the 1980s. During this time, many Latin American countries faced severe economic turmoil due to an unsustainable increase in foreign debt. But what caused this crisis, and how did it reshape the region? Let's explore. The economic boom and rising debt. The roots of the Latin American debt crisis trace back to the 1970s, a time of rapid economic growth and industrialization across the region. Governments in countries like Mexico, Brazil, and Argentina borrowed heavily from international banks and financial institutions to fund infrastructure projects, development plans, and industrial expansion. For many countries, the borrowing seemed like a good idea. Foreign debt was cheap, and the global economy was booming. But there was a catch. These loans were mostly in US dollars, and the interest rates were often variable. What seemed like manageable debt soon became a ticking time bomb. The global oil crisis and interest rates. The 1970s weren't just a time of growth, there was also the oil crisis. In 1973, OPEC, Organization of Petroleum Exporting Countries, raised oil prices, leading to massive inflation worldwide. At the same time, interest rates in the U.S. began to rise under Federal Reserve Chairman Paul Volcker in an effort to combat inflation. This combination of rising oil prices and higher U.S. interest rates made it much harder for Latin American countries to repay their growing foreign debts. In fact, for many nations, the cost of servicing their debts became much higher than expected. The crisis explodes. 1982. In 1982, the crisis came to a head. It was Mexico that was the first to openly declare that it couldn't pay its debts. In August of that year, Mexico's finance minister, Javier Garcia Paniagua, announced that the country was unable to meet its debt obligations. Soon after, other countries in Latin America, including Brazil, Argentina, and Chile, faced similar situations. The result? A massive financial panic, as investors lost confidence in Latin American economies. This was the beginning of what we now refer to as the Latin American debt crisis. The economic fallout from the crisis was immediate and devastating. Countries across the region faced hyperinflation, soaring unemployment, and a devaluation of their currencies. The cost of living skyrocketed, and many families found themselves in extreme poverty. Argentina, Brazil, and Mexico were particularly hard hit, with austerity measures imposed by governments in an attempt to curb inflation and meet foreign debt obligations. The region's economies entered a deep recession, and many Latin American nations were caught in a vicious cycle of borrowing and defaulting. The role of the IMF and debt restructuring. To address the crisis, Latin American governments turned to the International Monetary Fund, IMF, for assistance. In exchange for loans and financial support, countries were required to implement harsh austerity measures, including cuts to social spending, public services, and subsidies. Debt restructuring also became a key part of the solution. Countries like Mexico and Argentina entered into negotiations with creditors to restructure their debt, often extending the repayment period and reducing the total amount owed. While the IMF and debt restructuring provided short-term relief, the long-term effects were painful for the region's populations. The social and political consequences. The debt crisis also had significant social and political consequences. As governments implemented austerity measures, there were widespread protests and social unrest. Many people in Latin America blamed their governments for mishandling the economy and mismanaging foreign loans. In Mexico, Brazil, and Argentina, political instability grew as people became frustrated with rising inequality and economic hardship. Some countries even saw military coups and shifts in political power, as public discontent reached its peak. Recovery and long-term impact. The road to recovery from the Latin American debt crisis was long and difficult. It wasn't until the 1990s that many countries in the region began to recover. In the wake of the crisis, Latin American countries reformed their economic policies. Several nations embraced free market reforms, opening up their economies to international trade and investment. Mexico, for example, signed the North American Free Trade Agreement, NAFTA, in 1994, which helped stimulate growth. The crisis also forced many countries to focus on economic diversification and to establish better mechanisms for handling foreign debt. However, the scars of the crisis remain for many years, with lasting effects on income inequality, social services, and political stability. Lessons learned and modern implications. The Latin American debt crisis of the 1980s taught the world several important lessons about global finance. One key lesson is the danger of over-relying on foreign loans and borrowing in foreign currencies. Countries learned the hard way that debt must be managed sustainably to avoid an economic collapse. Today, Latin America has diversified its economies, but the region still faces challenges in managing debt and achieving equitable growth. The crisis also showed the global community the importance of international cooperation and effective institutions like the IMF in managing financial turmoil. The Latin American debt crisis of the 1980s was a defining moment in the region's history. It reshaped economies, altered political landscapes, and forced countries to rethink their approach to debt and development. What do you think? How have countries learned from the mistakes of the past, and what challenges do you think they face today? Let us know in the comments below. If you enjoyed this video, don't forget to like, subscribe, and hit the bell icon for more deep dives into financial history. Thanks for watching, and we'll see you in the next video.